sweet home, own sweet home. I dream of my own sweet home. Right here, right now, Amit Inamdar will show you how. Call Amit and you are set. Or just visit ownsweethome.net.
DRE license number 013555522 and NMLS number 236574.
Hello, namaste and welcome Radio Zindagi listeners. I am RJ Renuka. Today we have another exciting show with Amit Inamdar. Power Hour with Amit Inamdar. You are going to get the power-packed 30 minutes of information on complexity of loan transactions. We always welcome you to call us at 510-770-1550 to ask a question on the radio. However, if you are unable to get in, you can always submit a question for a personal response. Just go to Amit's website, ownsweethome.net, and click on the radio show link to submit your question. And you can always find Amit Inamdar just by searching his name on Google. So, listeners, the interest rates have dropped in recent weeks and it's good time to refinance, isn't it, Amit?
Yes, absolutely. Yes. Hello, friends, Own Sweet Home, and welcome to my show. Power Hour with me, Amit Inamdar. As Renuka indicated, the interest rates have dropped, and anyone who bought or refinanced before May 2013, or actually after 2013, is a good candidate to look at refinancing again. Those who are on the sidelines due to increased home values should get some comfort that even with higher home prices, their monthly payments will be lower due to low interest rates. To understand this interaction, just call me and I'll explain that to you.
So, Amit, we are going to talk today about the complexity of loan transactions. Could you please elaborate more on this?
Sure. The loan transactions are very complex and affect all parties involved in the transaction. Seller gets affected if the buyer's loan is not approved and the property comes back on the market. Buyer loses a home if the loan is not approved or goes south, and in normal refinance transactions, homeowner may get declined for better loan terms. So, it's not only important to get the right loan in the beginning, but also plan for future changes in your home ownership upfront. During the housing crisis of 2008, many people lost their homes for not planning properly, overextending themselves, or depending on attractive teaser rates. Wrong loan may break your home. And that is why it has become critical to work with an expert like me, who understands the emotional home needs and advises you objectively based on your ability to repay.
Amit, losing a home due to a wrong loan? Yes. I mean, many people got affected for that and the home crisis happened. So how do you plan for safer home ownership?
Right. The safer home ownership is very critical. Availability of the loans, for example, depends on multiple factors such as borrower, the type of property, and the lender that fits your specific needs. Being real estate and mortgage broker, I have access to over 120 mortgage lenders. As you know, rates fluctuates every day and sometimes during the day. There are many macro events that affect the rates, like drop in oil prices, where we saw interest rates drop accordingly, and some actions in the past, like Fed's decision to taper in the bond buying activity, or just yesterday's ECB's, the European Currency Board, decision to buy bonds, and the unemployment reports and GDP and so on. So all these events end up affecting the interest rates, and you have to make sure that if they go up, you are not affected based on the program that you chose, and it just becomes unaffordable for you down the line.
So, Amit, you do prepare your buyers, especially the first-time home buyers, for the unforeseen situations. So, I know you have a first-time home buyer webinar. We have talked about it before. It's a very comprehensive webinar, and it allows the borrowers or the home buyers to pre-qualify themselves using the tools on your website. You want to tell more about the webinar?
Yes, of course. The webinar, of course, is free, and it's easily accessible on my website, ownsweethome.net. If you want to learn about current market, the home buying, you can view the first-time home buyer webinar. If you are first-time home buyer or just want to feel comfortable with the home buying process, do visit the website and listen to this recorded webinar. This not only gives you the overview of the home buying process, it also gives you tools to pre-qualify you, lets you know more about the neighborhood selections, school selections. The link is located as an image on the left column and you cannot miss it. If you do not remember the website, just Google my name, Amit Inamdar, real estate broker, and you will get to this website. After you have viewed the webinar, all your questions may have been answered and you will have new questions with new information. That is when you can have one-on-one meeting with me for your pre-approval and neighborhood selection.
Yes, listeners, a first-time home buyer, this webinar is a must. So, Amit, with so many external factors affecting the interest rate, how should general consumer monitor or understand the direction of the interest rates, whether they are going up or they are going down?
Right. And see, I'm in the business of lending, so I actually monitor these rates on every daily basis. So being in touch with me, of course, helps. So daily monitoring consumers can do by using the published 10-year bond yield, and it's a good indicator of where the mortgage rates are headed. So when you come to me, I ask you very thoughtful question, understand your needs regarding refinancing or financing and getting into the home of your dreams, and guide you through the maze of options you may have as far as the financing is concerned. My job is to save you money. Many times homeowners run after refinancing every time they see a lower rate. However, every time you do that, you will add 30 years or to your loan repayment terms. That means starting the interest rate paying cycle all over again. Loan agents may not advise you on that because that affects their commission at the expense of increasing your cost of home ownership. Many loan agents promote 5 and 7 year arms for lower payment just to be able to churn the loan without showing benefits of already low 30-year fixed interest rates that give you peace of mind for the duration of the home ownership.
So, Amit, how does one go about the loan process? Listeners, you are listening to Power Hour with Amit Inamdar. If you have any questions regarding real estate or loans, studio number 510-770-1550, 770-1550. So, Amit,
Right.
you want to go talk about the loan process?
Yeah, absolutely, Renuka, and we welcome you to call us on the show here. If you are buying a home, I'm just a phone call away, and I can do a pre-qualification just over the phone and tell you the approximate range you will qualify for. If you are serious, I will actually pre-approve you for the loan based on thorough evaluation of your credit, income, assets, and ability to repay. If you are a seller of the home, in addition to marketing your home for sale, I first advise you whether you are in a position to buy first or sell later, or you must sell first and buy later. In this market, if you sell first, there is no guarantee that you will be able to buy right away, considering the tough competition in the market. So as you see, I work way different than a typical process of giving you just the rates and asking you to complete the loan papers in the beginning.
Yes, Amit. I also believe in the education. I mean, especially before you make that big decision on big items like getting financing. Could you please tell our listeners about your rate monitoring system you talked about?
Right, absolutely. The informed decisions always, Renuka, give everybody peace of mind. And that is my goal also. My clients have saved hundreds and thousands of dollars through my rate monitoring system. Once you work with me, I have your information. And when the rates drop, if it's going to benefit you, I will call you to alert you on your money saving opportunities. I know you are busy with work and family. So you need a proactive loan consultant like me who is going to keep you informed on money saving opportunities.
Amit, you mentioned earlier that every time you refinance, you add 30 years to the loan and may end up spending more eventually.
Yes, Renuka, that's absolutely true. I not only help my clients lower their monthly payments, however, advise on how not to add more years on the interest payments and the loan terms. You know, I can do loan amortization for as little as 8 years to 30 years and every year in between, not just 30, 20, or 15-year fixed loans. This saves you interest over the life of the loan. Remember, If you plan to retire at normal retirement age of 65, then you should pay attention to those extra years you add to the mortgage terms every time you refinance. Otherwise, you will be paying mortgage in your retirement years. Of course, in the retirement years, you don't want to be paying any mortgages, and that's why you want to retire. But home payment being a big part of your daily expenses or monthly expenses, you should actually make sure you buy a home before your 35th birthday, because the 30-year mortgages will end on age 65 at that time. We'll be back with...
Listeners, if you have any questions regarding loans and real estate, or if you have questions regarding the interest rate, different loan programs, studio number 510-770-1550, 770-1550. We'll be right back.
Have you joined the Happily Ever After Club?
Happily Ever After Club?
Happily Ever After Club. Membership is automatic once you buy your dream home from Amit Inamdar. He is both real estate and mortgage broker. One stop, no need to shop.
Oh, Amit Inamdar from Own Sweet Home.
Yes, that's Amit from OWN Own Sweet Home. Call him today, 510-364-6686. Again, 510-364-6686. Or visit ownsweethome.net. That is ownsweethome.net. DRE number 013-55522 and MLS 236574.
Hello, looks like we have a caller. Hi, this is Amit. How can I help? Hello, this is Amit. How can I help?
Hi, Amit. My name is Amit too. I just wanted a quick question. Most of these times when people say there's no point, 0 cost.
Right.
I know that it is not zero cost or zero. I mean, there is no free money basically. There is no free lunch.
Mm-hmm.
So what is the catch there?
See
how does it become no? How does it become, even in that terms? How does it become a cost?
Yeah. I understand your question, and I know these no point, no cost rates get advertised quite a bit. And of course the borrower is pays, because these are third party costs. These are not the fee charged by me or my company. It's just the fee charged by the other companies, like the escrow fees, the appraisal fees, and credit report fees, and the recording fees, and all that.
Own Sweet Home.
So you need to. All these fees basically add up, and somebody has to pay. And the way they get paid is, I'll give you an example of purchasing a car, and you can relate to that. Say there is a car worth around $20,000, and they say you can get 0% financing at $20,000, or you buy it today for all cash. They give you at $17,000. So basically, one way or the other, this particular car dealership is making money. If they give you 0% finance at $20,000, they pocket the $3,000 interest upfront, and you pay that $20,000 over a period of time. So the same thing happens with the loan. So to increasing the rate basically gives additional rebates for borrowers to cover their loan cost, and that's how the no-cost loans happen. Now, if you are in a declining loan environment, it makes sense to do that. But if you are in an environment where the rates are going up, then the no-cost loan will increase your rate beyond what's currently available in the marketplace. So you are absolutely right. It's the cost that always paid by the borrower. We have another call waiting. Thank you, Amit. Hi, this is Amit Inamdar. How can I help?
Hello, this is Satish from Fremont.
Oh, hi. How are you?
Go ahead. I had one question. Like, I'm a first-time home buyer, and rather than paying a rent of like $2,800 for a two-bedroom apartment, how good it is an option to buy a house with an FHA loan?
Right. So the thing is, certain costs for the mortgage interest are tax deductible, and that's where the ownership advantages come into play. So when you talk about FHA loan, that means you don't have enough money saved to put the down payment. And sure, you can do that. And if you actually go through my webinar, I have a spreadsheet I actually walk you through, which talks about how much money one could save. So on a conventional loan, let's say if you buy a $750,000 home with 20% down, your out-of-pocket expenses after the deductions for interest and property tax and the principal you paying to yourself are less than $2,500 a month. Okay. So the thing is, that's like a rough rule of thumb. I mean, that you can kind of look at for today's interest rates. And if you're on a loan like a FHA loan, the mortgage insurance is not tax deductible. So you may add, maybe it may go up to like another, $500-600 depending on your loan amount. And then you still will come out ahead, and actually you will own a bigger, better home than a 2-bedroom apartment at $2,800.
Correct.
All right.
Okay. Thank you.
Thank you. All right. So welcome back, friends. Again, thanks for the calls. This is Amit Inamdar, and if you are in the market to sell, buy, or finance your home, you will get unbiased advice that will save you money. And that's my promise to you. To get hold of me, just Google my name, Amit Inamdar, real estate broker, and you will know ways to find me. Having all your questions answered at one location and by one person means saving time, money, and having peace of mind that you are cared for by someone like me who knows this business. Today we are talking about important topic of loan process, complexities, and how to save money on home ownership.
So, Amit, there are many listeners who want to know, how do you get qualified for the loan?
Absolutely, and that's a very basic question. I should have answered that up front, and thanks for bringing that up, Renuka. In order to start the home buying process, I collect some documents from you as to qualify you for the loan. And those documents typically are like, for example, your W-2s for past 2 years. And they tell me that you have consistency of income. We also make sure that you are in the same line of profession for last 2 years. Then I look at your pay stubs to make sure you're still making enough money based on your history of employment. And then I look at your assets. These include assets from that can be liquidated in reasonable amount of time, like your bank statements, stocks, bonds, certificate of deposits, and any funds that you may get from overseas through wire transfers or any gift funds you may be bringing towards closing. I also look at your 401k or IRAs or any other retirement plan accounts, life insurance, liquidated amounts and things like that as a source of funds for down payments, as well as the reserves that are required by the lender to make sure you still can pay the mortgage in the times of difficulty.
So, Satish, you had called regarding the rent on your apartment, and if you can buy a home in that price range. So Amit has on his website, he has some free reports available. One of them is how to stop spending money on rent and own a home instead. You can go to Amit's website, ownsweethome.net, that is OWN, and request that free report. Hey. So, Amit, how does credit report comes into play?
Absolutely.
Everyone talks about my credit score is above 800 and mine is above 700.
Credit score is a critical part of the loan process. Okay. In addition to knowing your credit score, when I run your credit report with your authorization, I get to look at all your debts. These debts may come from your revolving credit card payments or car loans or student loans or other mortgages you may have, or anything else for that matter. Then I calculate your debt to income ratio, that is all your debts combined divided by your gross income. So on a monthly or annual basis, these ratios should be below 43%. This sets a stage for qualifying you for the mortgage. Now your loan is ready to be submitted to the underwriter.
So who is this loan underwriter? Is he what's his or her role in the whole process?
Right. See, the thing is, the loan underwriter is a person who, based on the guidelines set by the lender, the government, or the investor, analyzes your financial and credit history and worthiness to approve your loan. They are tasked with a burden of making loans that make money for the investors and don't go under, like borrower just walking away from the home, right? So they have to show tremendous diligence in analyzing your financing and credit worthiness. Having in this business for so many years, I have faced almost every type of situation, even though in this particular underwriting process. So when I look at your finances, I can tell you upfront what kind of underwriting roadblocks you may face and prepare you in advance by asking you right questions so that you can easily sail through the loan process.
Wow, those are big terms, Amit.
No, not big terms.
As a loan underwriter.
Right,
The
absolutely.
definition kind of what you gave.
Mm-hmm.
So, can we talk about the loan limits and also do the rates change with those loan limits?
Absolutely. So, first of all your borrowing ability depends on your credit score, like we talked, your income and your down payment. Lower credit score means higher cost of borrowing, meaning higher rates. Less down payment means higher cost in terms of either rates or mortgage insurance. Loan limits also play a role in determining your rates. For loans, for example, below $417,000, the rates are lower than the loans below $425,000, and these are the limits. $625,000. I'm sorry, yeah. So, and these are the limits set by the Fannie Mae, Freddie Mac on the loans that they will purchase from the lenders. Any loan that is above $625,500 is a jumbo loan, and at each of these loan limits, the rates are a bit different because the higher the loan amount, the higher is the risk taken by the lender. For example, like down payments also become different. Jumbo loans typically require a 20% down payment, even though in recent years, relaxation of lending guidelines, I have jumbo loans available with 10% down payment. So you buy $1 million home or above $1 million loan, you can get it with 10% down. I can do loans up to $750,000 with the government conventional loans combined with a second loan as little as 10% down payment also.
So, Amit, sometimes I hear about 5% down payment loans or even as low as 3.5% down payment loans.
Right. And those loans are, again, depend on the loan limits. Like we talked about the loan limit of $417,000, and you can buy a home as long as your loan is below $417,000 with a 5% down payment. FHA insured loans can be purchased with 3.5% down payment. So, and just remember, just next week, as of January 26, 2015, the FHA mortgage insurances are getting reduced by 0.5%, making the FHA loans affordable again. With low FHA interest rates combined with your low credit score, okay, remember your low credit score, one may be able to save money going with the FHA route than a conventional loan. FHA loans can be done with a credit score down to 580, whereas the conventional loans may require a credit score of 660 and above. I've seen some lenders going down to credit scores for the conventional loan also in today's relaxed marketplace.
So, Amit, you want to talk about today's rate, or you want to talk about the borrower requirements for the loans?
Let's kind of go give the taste of what the rates are today, basically, because we just have like a minute and a half left in the show. So, for the purchase loan amount of under $417,000, the rates for 30-year mortgages are 3.625%, APR around 3.68%. And these rates have slightly gone up over the last weeks because the markets have gone up, and anybody who locked last week has been lucky to kind of make that happen. The 15-year fixed rates are at 2.875%, APR 2.93%, and the 5-1 ARM rates are at 3.125%, APR 3.18%. Again, if you are going at the loan limits up to $625,000, the rates are 30-year 3.75%, APR 3.82%, 15-year fixed are just under 3%, APR 3.06%, and 5-1 ARMs are 3.375%, APR 3.42%. Just to let you know, you may find the APR or the ARM rates, like a 5-1 ARM rates, a lot lower than what I'm quoting you, but that means those programs have the initial change happening in your loan after 5 years, maybe up as much as 5%. So your rate may go up additional 5% after 5 years, and you don't want something like that. And that's why I kind of always tell you about having a safer mortgage.
So, listeners, Amit's website, ownsweethome.net, has a first-time home buyer webinar. Please go ahead and subscribe to that. And Amit's phone number, 510-364-6686.
Thank you again. Have a great weekend, and I look forward to seeing you next week.